All right, let's talk about the CAPM more specifically. I did hint at items such as the beta, risk-free rate, all these. I'm going to talk about them even more here. The time and place for it all, and here we are. So the three common methods of computing the cost of retained earnings. So as I said, cost of equity, cost of retained earnings, these are synonyms. Well, we've got the capital asset pricing model, which I mentioned is the most common method we'll use. And let's think about the name, right? It's the pricing model, so it's determining the price, the cost for capital asset. Well, for our stock right here. Now, key assumptions: the equal risk-free rate plus a risk premium. So, right, that's just saying we assume that we have a risk premium, a market risk premium, and if it says risk premium, that's also the same as market risk premium, just doesn't have the word market in it. The market risk premium is equal to the, okay, let's talk about some terms that we saw in our risk management session our lesson. It's the systematic or non-diversifiable risk associated with the overall stock market, and that's the market return minus the risk-free rate. This is our market risk premium. Also, you can see here it's called our equity risk premium. I feel like I'm going through a lot here pretty quickly. I'm gonna slow it down, but feel free to slow the video down, rewatch. I'm just trying to get it in here at a good pace for you all. Lots of wonderful points here. It's just a formula. Just to recap, it's just a formula taking into account the volatility of the stock, the expected return we're going to get, which is the market or equity risk premium, and then adding back in that risk-free rate. So key assumptions, again, here we've got the beta coefficient is a representation of the volatility or the risk of the stock relative to the volatility of the overall market. So a beta that equals 1 is as risky as the market, meaning here's just 0, right? Here's a straight line. Say the market goes up 1%, market goes down 1%, goes up and down 1% each day. If the beta of, let's say, Best Buy stock is 1, that means that the market goes up 1%. I'll use a different color for Best Buy. Best Buy goes up by 1%. Market goes down 1%. Best Buy goes down by 1%. Now let's say that Microsoft or Best Buy or one of these companies, Caterpillar, has a beta that's greater than 1, such as 1.5. That means market goes up 1% maybe. Those stocks go up a little bit more, and then it goes down 1%. It goes down a little bit more. It's a little bit more volatile. And then let's say it's got a beta less than 1, so a beta of, let's say, 0.85. Well, get rid of some of that there. Uh-oh. I got rid of my drawing. Well, it's less risky than the market, so the market goes up 1%, down 1%, up 1%, down 1%. Now, we are, maybe a more solid bond fund or something. We're going to go up maybe 0.5%, go down 0.5%, go up 0.5%, down. So you see how it's going to, it's more stable. It's more stable. Beta is not a good or bad thing, right? It's not a good or bad thing because maybe I want riskier stocks because I want them to be able to increase in value more. So it's just a metric, something to take into account. All right, that is our beta. And again, you don't ever have to calculate beta. It'll just be given to you. So if 1.15 is our beta, that means the stock is 15% more volatile than, for example, the S&P 500. Why do I say S&P 500? Well, because that is the listing of the relatively top 500 companies in the United States. And it's generally expected and generally used as an indicator of the market overall. So if the S&P 500 index goes up 1%, it's generally stated that the whole stock market went up by 1%. As mentioned, please memorize the formula. Memorize it as it's broken out method, right? So you could see this is the, everything as a whole, right? This is all of this broken out. Memorize it for sure. So the risk premium is the same thing as the market or equity risk premium, just taking into account beta here. That's the difference. The risk premium is just market risk premium multiplied by beta. All right, now our example here just gives us these numbers, nothing crazy. Gives us these numbers, WAC and CAPM, right? Sometimes they'll just give us the numbers and we're going to plug it in. Simple plug and chug. We plug in our beta, and something that tricks some people up, beta is not a percent. So we're going to leave it as 1.15. Whereas these percentages, we're going to totally do the trick where we move the decimal 2 points to the left. Beta stays the same. You do not move the decimal point. Now, 0.0975 is our market rate of return minus the risk-free rate of 3.25%, gives us our market risk premium times the beta, and then add back in that risk-free rate. That gives us a cost of retained earnings of 10.73. So you see here, could have given us that, and then we plug that in as the cost of equity. Now, just more about the cost of equity, right? It takes into account time value of money, dividends paid. Like generally, that's what these different metrics could use. Discounted cash flow takes into account dividends. This takes into account the volatility of the stock, right? And it's the return and risk-free rate, all of that. So you don't really need to know it more in depth. I'm just going to kind of hint at what is taken into account with this cost of equity. There are more complex models. There are sometimes people, even in valuations, will just use a predetermined cost of equity. It's just generated by some software. But for our purposes, we are going to just be doing it this way, right? So our market risk premium is 6.5%, which is the market gain over the risk-free rate. So without thinking, without risk, without losing a single hour of sleep, you could have put your money in the risk-free rate, the treasury bonds, and earned 3.25%. But you chose to put your money in the market at 9.75. So you are essentially getting a 6.5 premium over the market. Sorry, over the risk-free rate by quote unquote risking your money. Now, are you risking your money by investing in the top companies in the US? In the short term, I suppose, but overall, and I would hope for the sake of everyone and all of your 401ks and retirement plans, that the market continues to go up. Well, that was our CAPM, and as mentioned, we have other ways to calculate the cost of equity, such as the discounted cash flow. All right, so for example, in a question, if you're doing WAC, and it doesn't give you the cost of equity, but it says the discounted cash flow is, right, like 11%, well, then you can use that as the cost of equity. Here is a formula to memorize, and you see it here, I call it the cost of retained earnings, but you could also say this is the discounted cash flow formula, it's the cost of equity. Technically, this is the discounted cash flow formula. This is. It's just called the cost of retained earnings because we can call it that. I want to get you familiar with all the different nomenclature that we can use. All right, so keep in mind that share price is completely irrelevant when calculating dividends. I make this point in FAR and here. How is a dividend determined? Well, the board of directors says, okay, we're going to pay out 0.25 or 25 cents a quarter. That is what's happening. It's not, some people think that the dividend rate is like, okay, 6.5%, we multiply that by the stock price. No, the rate is actually determined based on the dividend amount paid. So to determine what the dividend rate is, you would just do the dividend per quarter or per year divided by the stock price. And this will change day by day as the stock price changes. So just keep that in mind. We are not dependent on the share price for the dividend payment. The par value of the share, or the share price, is only relevant for dividends of preferred shares because, remember, that's much more like debt. So it multiplies it by its value. Just an important point I'm going to drill home for you. All right, we've got a couple different factors here. I'll talk about these when we get into the formula, but let me read what we've got. Boardwalk Investments Inc. has had a consistent dividend growth rate of 6.5% per year. Now, yeah, management, sure, they can try to have a consistent dividend growth rate by determining what they want their dividend to be. That's fine. They can try to, make it consistent, but this is determined based on what they decide to pay in dollars. The company just paid a $1.50 dividend in year one. So that's an annual dividend. The end of year one, the fair market value of its shares of stock was $30. As mentioned, this is irrelevant. Cross it out. Great. What is the cost of retained earnings using the DCF, discounted cash flow method? Awesome, awesome, awesome. Well, okay, let's see. Well, share price is not used to determine our dividend, but we need it for our discounted cash flow. So I crossed it off because we didn't need it to calculate dividend, but we will need it for the formula. Now, plug and chug, right? Plug and chug. You could also kind of think about this formula. What is it? Well, this is the dividend expected at the end of year one, so D1. If we had D0, that would be the last dividend paid. And I know the D1, D0, D2, P1, that confuses people. So I'll definitely address that as we go through different questions, especially ones here and other lessons as well. So just memorize the formula and memorize what they are and practice these questions. So dividend divided by price, this gives you the dividend rate, right? Like what's the dividend yield on a stock plus the growth rate? What's the expected growth rate for another year? And this gives you generally what you expect as an investor to receive per stock. And just like as a company, what's the cost of borrowing money is interest. Now, the cost of giving up your stock to an investor is the dividends you pay them, as well as the hard to determine cost of giving up your own stock based on the price of it and not benefiting from yourself. But the easiest way, I think, conceptually to understand cost of retained earnings or cost of equity is discounted cash flow, because it's a solid number, right? It's the outflows. The cost of issuing stock as a company is the dividend you'll pay to investors. Awesome. Now you see here, sometimes you have to calculate D1, right? And that's what we'll have to do. It's totally fine. And let's run through the question. So first we write out the formula as is tradition, as is tradition practice for any question. Just write out the formula. Just do it. It'll be helpful. It'll help you memorize everything. Now, D1 is the dividend per share expected at the end of year one. It just paid a dividend of 1.5. Well, we're going to use the last dividend paid. So this is actually D0. So you see here, I said we're going to address the fact D0, D1 confuse people. So this is the last dividend paid. How do we get D1? Well, here's the formula for you. Another formula to memorize. It's D0 times 1 plus the growth rate. So that's expected next year. It's just multiplying it for next year, right? What you expect it to be. So that's $1.50 times 1 plus 0.065 gives you $1.60 expected at the end of the next year. So that is the amount we'll use. We plug that into D1. Again, you can use this just as a very straightforward plug and chug formula, or think about it a little bit. Definitely use a little bit of both, but you really can't answer this unless you memorize the whole formula. So D1 is $1.60 divided by $30 per share, plus another growth rate as is stated in the formula. This gives us a WACC, not a WACC, it gives us a cost of equity or a cost of retained earnings using the DCF of 11.83%. That is our second method for determining the cost of equity or cost of retained earnings. I hope this is going pretty clearly and going well for everyone. I know this material, this topic can be super tricky. When I was learning this using certain study courses and materials, it was not very clear to me, for sure. So hopefully I broke this down, made it as clear. And I don't want this to be textbook. I don't want this to be very high level education. I want this to be very down to earth, practical. I don't want some lofty PhD level. No, I want the down nitty gritty explanation, and this is as pretty clear and concise as you can get. All right, our last one, we've got bond yield plus risk premium. Last method to determine the cost of equity or cost of retained earnings. And we see this as the pre-tax cost of long-term debt plus our market risk premium. And we have seen our market risk premium. We've talked about that before. Here it is again. This is just essentially taking the cost of our bonds and adding on the market risk premium. It's another metric. I'm not really going to go into too much. Just kind of memorize what we do. This is the least common that you'll see, but still it's pretty simple. As you can see, just definitely memorize it. We've got Boardwalk Investments again. We're currently expecting an 8% return from the market. So that's the S&P, right? The overall market. The company has also observed that the yield on the treasury bonds is 3%. So you can rest assured you're guaranteed 3%. Lastly, the yield to maturity, or just essentially the cost of debt, right, on its own bonds is 10%. So it's paying out 10% on its own bonds. What is Boardwalk's cost of retained earnings using the bond yield plus risk premium method? Super plug and chug, easy formula. Market risk premium is our market rate minus the risk-free rate, 5%. Cost of retained earnings, add that on to our 10% of bonds, and we get 15%. Bada boom, bada bing, we got it, right? Nothing too crazy, nothing out of the ordinary. And just to recap here, all three methods could be how you determine this number right here. How does it all fit into the bigger picture? This is how it fits into the bigger picture. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.